I'm Cathal McGlinchey, and it's my great pleasure to bring you the Irish Funds panel, Expertise for a New World, the Future of ESG Skills and Data Management. Irish Funds is a representative body for the international investment fund community in Ireland and has been a leading voice for the investment funds and asset management industry for over 30 years. This wealth of experience and knowledge has contributed to cementing Ireland's reputation as a European Centre of Excellence when it comes to supporting and enabling investments. So you can check out our website at www.irishfunds.ie for the publications we're going to be referencing during the presentations. I'm here today with a team of experts, and over the next hour, we're going to bring you some context on how the industry has evolved. We're going to catch up on the data challenges and then into ratings, and finally, I'll take a run through the skills gap and what we're doing and the implementation work there to really bring that forward. All that through a mix of slides and panel discussion. My name is Cathal McGlinchey, and I head up Financial Reporting Solutions in KPMG Dublin, where I provide tech-enabled solutions for our clients to help them scale their financial statements reporting process. My own background is I have over 23 years of financial services experience, more than half of that in industry, and I'm here as chair of the Irish Funds ESG Servicing and Data Working Group. I've previously chaired the Financial Reporting Working Group and held other leadership roles both at European and local level. So the first slide here is the agenda, really. It illustrates what lies ahead. So now that some of the regulatory requirements have been given a bit of time to bed down, key focus on our side really is on implementation and how we remove obstacles on the data and skills side in particular. Most industry participants are struggling with implementing the new requirements, so we've broken it into a number of stages. First speaker up is Ciaran McMurdo. Ciaran is Product Development Manager at Mediolanum. He has 15 years asset management experience in a variety of distribution and product roles. Ciaran has previously worked at Pioneer Investments and later Amundi after it acquired Pioneer. And at Amundi, Ciaran was part of a product team that oversaw expansion and integration of ESG investing capabilities across the fund range. At Mediolanum, Ciaran is heavily involved in the Med in Sync process, which is the company's main ideation process. The Med in Sync process touches base with over 65 asset managers in the industry to seek product proposals, many of which are ESG related. So Ciaran's going to lay the scene on the evolution of data and product development, followed by a panel discussion on key points. To Ciaran's left then we have Jack Lee. Jack is Vice Chair of the Irish Funds ESG Servicing and Data Working Group. Jack is a Product Development Director and leads the ESG offering at MUFG Investor Services, where he's responsible for developing new services and products. He is also Head of Sustainability Reporting and is responsible for ESG reporting based on the metrics and targets set by the company. Jack's a qualified accountant and has certificates in sustainability courses including UNPRI, TCFD and EU Taxonomy. Jack's going to cover the challenges of the ESG data and the current ESG ratings market, SFDR and taxonomy alignment, followed by a brief panel discussion on the key points. And then after Jack, we've Deirdre Timmons. Deirdre's a member of the ESG Servicing and Data Working Group. She's a Director of Sustainable Finance with PwC Ireland, involved in helping a variety of clients with a sustainability agenda, and in particular, how their strategy and reporting around sustainability impacts their access to capital and financial services, or, as capital providers, how to deploy that capital in a sustainable way. Prior to joining PwC, Deirdre worked in a variety of senior roles across financial services, including Bank of Ireland, the NTMA and AXA Insurance. Deirdre holds a Master's in Sustainable Energy Finance as well as a Master's in Investment and Treasury. So Deirdre's going to run through the other upcoming requirements, particularly the increased disclosure around ESG metrics and the ratings for funds. And then finally, I'll run through the skills paper completed by Irish Funds, which covers the root causes of the industry skills gaps, along with the details of the implementation, which is currently in progress. I sincerely hope you'll enjoy the panel, and without further ado, I'll get Ciaran to kick off and set the scene for us.
Yeah, thanks, Cathal. Thanks for that. So I'm just going to proceed here now and have a look at a brief timeline of product development in ESG. So a lot of what we're doing here today is to think about skills and data for the future and where we might be going. But it's always good to take a step back as well and to see where we've come from. It often helps to frame the picture about where we might be going. I've always worked on the manufacturer side, within asset managers. So here I've put together a brief timeline to show how I've seen the whole trend around ESG investing develop within the funds industry. So I've split it up into four sections here, and I've also tried to apply as much practical use as I can, to talk about things such as what new approaches came in, or to give you fund examples, because I think this helps. And then at the bottom, I also have shown data sources and reporting requirements as the timeline moves on. So the first period I like to think of is the early beginnings, we'll say the 1990s. Here you had what were very niche managers that were actually covering this space. A lot of what they relied on was in-house developed criteria, and many might remember terms such as ethical investing at this time. So we hadn't even got to, we'll say, ESG. It was largely ethical, sustainable. An approach that was very common at this time was what was called exclusion investing. This was where certain sectors or activities would be excluded from a fund. You had typically only equity funds at this time. And to give you a good example of a fund at that time was Ocovision, which is a global equity product. So this was one fund that was one of the early kickstarters during this period, let's say. And what I like to do is use funds that are actually still in existence, because I think it highlights that those managers that were the early starters, they've actually continued to maintain a strong presence. So you see there the product still has 2 billion in assets currently. Now on the bottom, what I've shown is how the data sourcing and reporting was done. So as I said, it was typically in-house. It was using own reporting standards, and then at will. Then what happened was we moved forward another period, and we went through a phase of what I would call the early breakthrough years. This was where ESG became a recognized term. Here you had the release of the UN Global Compact report, and called Who Cares Wins, and this was where we officially came across the term ESG, as with reference to investing. The approaches that started to kick in then were more on the side of inclusion, engagement. Now these are still very common. Some of them are even more common now, but they were some of the new innovations that started. Again, it was primarily equity funds. To give you a good example, there was a Pioneer Investments Global Ecology Fund, and it was the first well-known mutual fund in the equity cross-border space to cross the 1 billion mark in assets. So that was around July 2007. Now what I haven't shown here is the impact of the financial crisis, which definitely set this whole trend back a little. But aside from that, we then had April 2009, Morningstar introducing what is now called the Sector Equity Ecology category, and this has ended up being a huge product category for ESG type funds with 95 billion worth of assets in it at present. During this time, you also had rating agencies emerging. So one great example was a German company called Oikim Research, and they were formed in 1999. And they provided a lot of their own metrics. So this started to transfer then a little into the industry, along with other providers. So what I've noted here is that sophisticated ESG investors started to demand some ESG metrics in commercial material. So you can see the picture is developing. What we have then next is definitely what you'd call the breakthrough years. So here you had a whole raft of new launches starting to emerge. You even had specific ESG areas being targeted. You would see some of the early themes such as water, energy being targeted here. The UN SDG goals were adopted in 2015, and Morningstar introduced the fund sustainability ratings in 2016. So this was a big event as well. And then you had new approaches coming in, such as impact investing, and inclusion grew even stronger again. And what you had started to see during this period was multi-asset ESG starting to grow rapidly. And then we have funds such as Fair World Fund launching in 2010. So this was a great example of a multi-asset fund which even included allocations to microfinance funds. So again, bringing things forward, new innovations. We had external data sources growing a lot, and then we had a lot of managers aligning with the SDG goals, which was a very common thing and still is. And then finally, what I have is, the last period, the COVID period, let's say, and what I call bifurcation, like where we're likely to see those genuine ESG funds and those that aren't, and we have a divergence here. So obviously, COVID supercharged the ESG investing team, as many know, 800 plus European ESG fund launches in 2021, to give you an example, and here you had a lot of deep impact investing appearing, and one great example of this would be where products donate some of their revenue towards causes, charities, etc. And an example is AXA. So they committed during this period to donating 5% of their management fees on their impact fund range to charity. So in this period, you had data becoming a legal requirement. So a lot of what we're going to talk about, what you're hearing, SFDR, taxonomy. But the key point is that the whole time we've been moving along, the data requirements have been changing from what are in-house and chosen at will to more and more a requirement. So this is the big shift that occurred. Now in the following slide, I want to also show a very good practical example, which is I did a little bit of digging here, and I chose a fund that's been around some time. It's the Schroders Euro Corporate Bond Fund. I chose this fund because it's SFDR 8, which I think is interesting. I'll explain that in a minute. And I went through the timeline of what I've gone through with you to take a look at some of their fact sheets and some of the ratings, external ratings that they're using or showing. I think this is a very interesting exercise because what it shows is that when we go way back, the fund managers were typically showing like a fund management rating reflecting the asset management house, or a Morningstar star rating which covers risk-adjusted performance. But then as we moved along, other ratings started to appear. In this case, they started to show a fund analyst rating, and many will remember these. This was short-lived, and then was replaced by what are in-house sustainability metrics that Schroders started to use. And then the most recent fact sheet that we look at for this same fund, we see that actually performance, the manager's rating, the analyst's rating are not included. They're not prominent in the fact sheet, not considered as much. What you actually see is other things such as MSCI ESG rating, Morningstar sustainability rating, a proprietary sustainability metric that Schroders has developed called SustainX. And also in this fact sheet, you see many other examples of ESG ratings. So here, I think this shows the timeline of events as well, and shows how we've come to a stage where sustainability ratings, information, data is overtaking other parts of marketing material and product material. And this is all highlighting the development in product development, the life cycle movement that we've come through. Now, the final slide I want to show is some flow data. Now, many will have seen this, you know, might be covered in other modules, but I think it really highlights why we have come to a stage where sustainability ratings are so important, and maybe why some managers are actually designing products with sustainability ratings in mind rather than other reasons. So what I collected here from Morningstar is the 1 year flows into the European open-ended fund universe. And what you actually see is that on top, the Morningstar ratings, which were traditionally a very strong determinant and tracker of fund flows, weren't actually a fantastic measure of where the money was going. So you see the 5-star funds over 1 year attracted 18 billion, 4-star funds shed 54 billion in assets. But if you look at the lower table, which is the sustainability ratings, you see that over 1 year, 5 globe products, as Morningstar calls them, globes, attracted 22 billion in assets. Funds with 4 globes attracted 26 billion in assets. So not even any outflows during a difficult market period. So this to me highlights the very strong nature of these sustainability ratings and why managers are really considering products in this regard and seeking to have these high sustainability metrics attached to their products. And these are a few of the areas that we're going to talk about a little later. So I hope you found that useful and insightful.
Thanks very much, Ciaran, that's great. Maybe just one question to the panel just on that. As we saw the example you gave, like over 50% of the fund fact sheet is sustainability information. Like, how important is that now for investors on that side?
Yeah, so it's obviously very important for investors. Some are more sophisticated than others, so they can figure it out better. I guess the bigger question maybe, Cathal, is not how important it is, but where is it going? And it probably also highlights the need for stronger regulation. You could potentially argue that, you know, if we kept going this way, it would almost look like the Wild West of sustainability ratings, right? That you would just have, you know, cherry-picked ratings, in-house metrics, external ratings, and then it makes the life very difficult for a fund investor, which is probably why we now have the scenario where regulation is coming strongly into force.
Might let you come in on that as well, Jack, because I know you're going to be coming in a little bit later with the challenge around multiple data sources.
Yeah, I think like it's nearly now, is there too much information on the fact sheets that actually is confusing an investor? I think a really good example that Ciaran mentioned, you've got multiple ESG providers have ratings, you have an internal rating. What does it actually mean to the investor? Do they actually know how to interpret it? I know we're going to talk a little bit about the skills, which I think is a really important piece. Like, do we have the skill set to interpret that? And I think that's the question, is if over half of your fact sheet is now ESG information, how important is that in terms of assessing, one, does it impact the performance, but two, am I confusing an investor with all of these different ratings?
Yeah.
So I think that is important, and I know I'm going to touch upon some of those challenges with, you know, ESG data that's coming up. Like, so that would sort of be my sense in terms of the fact sheet. Like.
Well, I might just let you lead into that then, like really with the challenges around that. I know there was a huge amount of work done this year and last year investigating that, so I might let you take that piece away.
Yeah, no, and so again, my name is Jack Lee, like head of ESG product at MUFG Investor Services. Like, one of the things that as part of the Irish Funds ESG servicing and data working group, we spent quite a bit of time, and I suppose in my role I spent quite a bit of time working with a number of ESG data vendors, assessing data, looking at the regulation, sort of understanding what's coming down the road, and how asset managers and users of this information are really going to be able to interpret it. And some of the things that we've sort of looked upon are, you know, what are the challenges that are here today in the market? And so what I'm going to touch upon is, you know, those inherent challenges in ESG information, specifically touch upon the ratings, and then also touch upon SFDR and taxonomy, because there's a lot of data elements that relate to those two regulations, which I still believe there's a lot of unknown in the market out there at the moment. So we want to just kind of highlight some of those. And look, although I'm going to talk about challenges, it's not all doom and gloom. Like, there obviously will be some progress, and we'll talk a little bit about that later in this session. So I suppose when we first look at the challenges with raw ESG information, one of the big questions is coverage, right? So we know Europe is leading the way in terms of ESG regulation. It's very much pushing it to the corporate issuers, the funds, etc., in terms of disclosing around ESG information. We then look at the US. The US is lagging behind a little, but we have seen a lot of progress from the SEC in terms of ESG regulation that they're looking to put in for advisors. Then we look at APAC, and again, the authorities in APAC are very much starting to come to the table and are very much more being active on that ESG side. The second thing that we look at then is private assets. So a lot of the regulation that we're looking at is very much focused in on, you know, getting data for the public assets, but actually the private asset market is a huge market in terms of where a lot of fund flows are going. And actually, can we get that same information on private assets? So again, the coverage piece becomes a big question. The next area then, in terms of correlation to performance, I think one of the things that's happening right now is we're nearly at a perfect storm in terms of a geopolitical, social and economic factors that are all impacting the globe at the moment and really actually impacting performance of assets. So I think all of those things are likely to continue. And one of the big questions that is out there at the moment is ESG risk really built into performance? Good example is the energy market. There's a shortage in energy at the moment. But when we think about it, what companies are performing the best at the moment? It's the energy companies, but they have the biggest climate risk in terms of how they need to transition away from that. So again, is ESG risk really built into the factors for those underlying companies? If we look at methodology, I think Ciaran mentioned this a few minutes ago, you've got multiple methodologies, multiple vendors or multiple managers are disclosing multiple ESG ratings on fact sheets. How are those methodologies come about? Some of the ratings are done on an alphabetical basis, some are done on numerical, some have different scales, some have different weightings in terms of focus on the E, the S or the G. So again, it's understanding the makeup of those ratings and what do they really mean from that perspective. One of the other things then is that some of the ESG providers very much focus on the negative. So I've seen it where they look at ESG indicators, and if you have a controversial or negative impact on it, that impacts the ESG risk. But do they look at the positive factors? What are all the good things that companies are doing? And actually, does that really impact the ESG risk of a company? And I think it should. But again, are vendors looking at that? Lastly, then, the reliability of the sources. Where does the information come from? Is it assured? Is it disclosed by the company? Is it disclosed by third-party sources? Again, very much an area of a challenge in terms of the reliability of the data. And then I think as part of the Irish Funds Working Group, when we did some analysis, and I'll touch upon this when we talk about SFDR, the timeliness of the data, funds having to disclose ESG information, let's say for our periods 31 December, some of that information from the underlying corporates is only published in maybe 2, 3, 4 months after the year end. How does that information feed into the funds? Do the data vendors actually, have they analysed it and got that information into their database for the asset managers to be able to assess it? And was also a 1-year time lag in terms of some of that information. So it is some of the things that we need to think about in terms of those challenges. If I move on then to the ratings, I'm going to touch upon only some of these areas. I think there's a big bias towards large companies. So the large companies have the resources, small cap, mid cap companies don't. So for some of the vendors, they do ESG questionnaires out to those companies. They can obviously respond to them, those large caps, the mid cap, small caps can't. So actually, is there a preferential treatment in terms of the bias towards large companies? We think about the correlation. And I suppose as a panel, we had a discussion more recently about the credit ratings and how the credit ratings have evolved. So there's been many studies that have proven that there's actually quite a high correlation between credit ratings between different providers. But actually, when we look at ESG ratings by the providers, there's not as big a correlation. And ESMA had done a study on this to say 99% of credit ratings between different providers for a specific asset, there was a 99% correlation. But for ESG ratings, there was only a 60% correlation. So again, are we really comparing apples with apples in that case? I think a big one now, which I'm not sure a lot of users of information would be aware of, is the conflict of interest. So a lot of sustainability rating providers rate underlying issuer assets. They also provide, for example, advisory services like second-party opinions on green bond issuances. So if they're generating additional revenue by providing a second-party assurance opinion, but also providing a rating on an underlying company, what does that really mean? How is there some type of conflict of interest there that needs to be thought about? We've talked about transparency, the weightings of the methodology, the types of indicators that each of the rating providers focus in on. So again, one of the things around transparency methodology is really important. The last thing then, which again, Ciaran touched upon, is the internal ratings. So now we've got manager ratings being created where we've got ratings that we're taking ratings from ESG providers, but now creating an internal rating, which is now creating a third level of another rating that we need to assess. So again, does the user of the information really understand the methodology behind it? I would say in a lot of cases, most managers or most vendors are saying it's proprietary information and we don't want to disclose it because it's their IP. But for a user, you do need to understand what actually feeds into that. If we move into SFDR then, because obviously SFDR comes into play on the 1st of January 2023, there are a couple of things that are specifically on SFDR where there's some data challenges, right? And what we're looking at is really some core questions that need to be answered. One is the definition of sustainable investment. And does that mean, like, for example, if you have assets like equity or debt instruments that do not have the definition or use the use of proceeds term, can they actually be sustainable investments? And I think there's some questions out there with the regulators around that. And I know Irish Funds is liaising directly with the central bank on these particular questions. The second thing then is around taxonomy and taxonomy alignment. So for Article 8 funds that do not have a specific commitment to sustainable investment, but let's say they have environmental characteristics, will they need to do taxonomy alignment? And the likelihood is yes. But in doing taxonomy alignment, do you effectively or inherently, does your investment now become a sustainable investment? And it's a big question mark in terms of the presentation of the makeup of your assets on the left-hand side of this particular slide. So again, it is a challenge that the industry needs to deal with. Two other areas, specifically around the disclosure around subsectors and also top investments. What does that look like? There's no prescriptive definition in the templates that have been released by the ESAs. Again, we're obviously lobbying with the regulator specifically on what does that look like. The likelihood is you're going to get different interpretations on this when the disclosures become into play on the 1st of January 2023. So again, we will see a lot of, I suppose, discrepancies across different fund managers and how this is disclosed. Again, may cause confusion across the industry in terms of how they view this information. If we move on specifically then to the principal adverse impact indicators in SFDR. So as part of Irish Funds, we did analyse the indicators. We did an analysis specifically with all the vendors. There is a report that's out there if anyone wants to read more about it. But we redid the analysis this year to very much see how has the indicators progressed in terms of coverage. And part of it is we can see that 2 indicators have increased, 1 has decreased, most of the rest of them have stayed the same. Part of the issue with the indicators is, and I suppose what is the underlying companies, and they're not disclosing certain information around these indicators. What I would say is that from discussions with most of the vendors out there, they've got a roadmap specifically around how they are going to address this, how they're going to capture more information specifically around the principal adverse impact indicators. And it is something that as more and more funds start to adopt this, the likelihood is that the PAI indicators are probably going to be not mandatory, but nearly an ask or an industry standard that nearly all ESG funds will have in place going forward. Although not mandatory for Article 8 funds, the likelihood is that as this becomes, as fund managers start to disclose it, you'll probably see it will become an industry ask. So something to be aware of and obviously something to think about. The last thing that I want to touch upon is the taxonomy. So we all know taxonomy is complicated. Data is going to be really, really important for this. I wanted to highlight 2 things here on this particular slide. One was Tesla as an organization. Tesla is a US-based company. The taxonomy is all about substantial contribution to one of the 6 environmental objectives. Taxonomy or Tesla's revenue is very much going to be aligned to that substantial contribution, right? The challenge is that Tesla is a US company. It does not apply EU taxonomy. But the vendors have gone and done an analysis, and then you can see here on the slide, in this particular analysis, the vendors have a varying degree as to how much of their revenue actually substantially contributes to taxonomy alignment. So you've got a question as to, is the taxonomy alignment number being published by the underlying company, or is it being published by or based on a methodology done by the vendor? And that will be a question for the users of the information as to how to interpret that. If we look at ABB Automation, which is a Swiss company, similarly, again, you've got varying degrees of what's being disclosed. One vendor has disclosed 100% contribution to the environmental objectives, whereas the other 4 have basically a very low contribution. So again, how reliable is that information if the vendors are doing the assessment rather than the actual underlying companies? So I think that's going to be a big challenge for the industry in terms of that taxonomy alignment. And I think one of the bigger challenges at the moment is that lots of companies are only starting to do that assessment, and very much those European companies. Then it's whether or not those vendors are going to do that assessment as well. So I think they're some of the key challenges across, the existing ESG world that we have that we really do need to think about and that users need to think about at this point. But again, as I said, it's not all doom and gloom. There's definitely going to be improvements, and we're obviously seeing that across the vendors and obviously across the universe as well.
Thanks very much, Jack. That was great. And just in the interest of time, I think we might move straight across to Deirdre as well there, who's going to take a look at the additional standard setting initiatives and the additional requirements that are emerging as well, that have been taking a huge focus in Irish funds.
Brilliant. Thanks very much, Cathal. Yes, so I suppose hopefully some of this will address some of those data gaps that Jack has just been referring to. At the moment, in terms of companies actually reporting a lot of the information that's needed by PAI or taxonomy, it's only those that are in scope for non-financial reporting directive currently, which is only 11,600 companies across Europe. So obviously Europe needed to address this because it's requiring investors to report under this. So they are addressing that through the Corporate Sustainability Reporting Directive. That will increase the scope of companies that are going to have to report on many sustainability issues, from that 11,600 that I mentioned to around about 50,000. So it takes a huge amount more companies into scope, and certainly will provide investors with a lot more information directly from the company itself, which is really required here to fill those kind of data gaps. Clearly, that's only one jurisdiction. Most European funds are invested globally. So we are starting to see, as Jack said, some initiatives across the world which hopefully will address this as well. One of those being the SEC disclosures. They've started with climate. And I suppose, politically, it's going to be challenging to get a lot of these across the board here. So start small and work from there. And then we've also got the International Sustainability Standards Board, which also is starting with climate and also some other sustainability metrics in there as well. All of these are at proposal stage at the moment, I should reiterate, and all of these proposals have just been through public consultation process. So anything that I may talk about in this context today is still subject to change, but it'll give us some idea of the direction of travel. So just looking across the three on a very high level basis, and as I said, in terms of jurisdiction, it will help in terms of getting that global focus. We don't yet really know where ISSB will actually capture. It'll depend on regulators in certain territories whether they adopt that into their own regulation or not. In terms of when these disclosures are likely to happen in Europe, we will see reporting starting from 2025 based on full year reporting for 2024. We're seeing a phased-in basis on the SEC for full year 23 onwards, and the date isn't specified for the International Sustainability Standards Board yet, but we would expect it in around a similar sort of time frame. In terms of who this reporting is directed at, very much the SEC and the ISSB is very much directed at investors. The CSRD is also directed at investors, but would have a bit more of a wider stakeholder focus as well. Certainly the CSRD disclosures go a lot further than the other two that I'm talking about. Interestingly in all of this, because we have been talking about the challenge of data, and in terms of the fact sheets that Ciaran spoke about earlier and so on, data is only as good as its reliability. And that's a key challenge here as well. And so I think it's interesting to see that with a lot of these disclosures, assurance around the data is certainly going to be a feature of that. We're going to see assurance on CSRD, starting with limited assurance, moving to reasonable assurance. In terms of SEC, they're talking about it having assurance over certain aspects of its scope 1 and 2 emissions, for example, and then phasing in probably from there. And in terms of there's no other requirements at the moment, but I did say would have to be adopted by regulators in certain jurisdictions, and they may decide to have assurance over it in those jurisdictions. So I think that's a very, very positive move forward with all of these disclosure requirements as well, giving assurance, giving that assurance to investors that they can rely on the data that is coming out as well. I suppose maybe just to talk very briefly as well around what they are trying to capture here. So from a materiality perspective, because Jack mentioned about the financial impacts of ratings and how investors are looking at all of that. So certainly on the CSRD reporting, they will be looking at the concept of double materiality, which is really extending beyond the traditional look at materiality that many companies would be reporting under currently. Financial materiality will be coming in under SEC requirements and also ISSB. So just wanted to also touch on the rating side of things here, but in this case, I'm going to be talking about the ratings of funds. Jack has already referred to the rating of companies. And the reason we're talking about the ratings of funds here is since August of this year, there has been a requirement for within Europe for financial advisors and discretionary portfolio managers to take into account the sustainability preferences of their clients. We've talked about Article 8 and Article 9 funds here. There's very open-ended definitions of what they are, and there's still not a commonality of approach by a lot of asset managers in terms of how to apply those definitions to that. So it can be very, very difficult for advisors to really understand and compare across funds. Particularly at the moment, we also have the added difficulty that we are operating within a level 1, as it's called, disclosure requirement, where we have very, very basic information on some of those funds, and we won't get the level 2 requirements until they come in until next year, which will give a lot more information. So those advisors are working in a vacuum at the moment. As a result, a lot of them are relying on third-party fund ratings. So AFAMA decided to have a look at this and see how that was operating at the moment. So they did an analysis just a short while ago, and they looked at two of the ratings providers, Refinitiv and Morningstar. And they have two very different methodologies about how they approach ratings. Refinitiv, for example, would look at the relative ESG performance of a fund and its commitment and effectiveness, whereas Morningstar would look at the financially material ESG risks when compared with similar funds. They analysed 1,500 funds, and then they mapped them, as you can see in this chart here. Each one of those funds is represented by a green ball. I think it's fair to say that they found fairly limited consistency between all of this, and as a result would say that advisors should treat with caution the ratings that they are relying on in this regard. One of the other things they took a look at was whether these ratings would give a very good rating to, say, Article 9 funds, given the high bar of the disclosures of those funds. And they did find that generally those Article 9 funds were rating higher. That led to a little bit of concern that maybe if investors express a preference for sustainability objectives, that they would only be shown Article 9 funds, where in fact many of the Article 8 funds would probably also satisfy their particular requirements. So I suppose 5 things that came out of that AFAMA analysis was that discrepancy of views between the different providers. Also, they called out the fact that many of the really big ratings providers operate outside of the EU, and they don't necessarily follow the EU standards. So those relying on them for advice within the EU, may not necessarily be aware that it doesn't necessarily align with the EU objectives. They also called out in that regard that there's a lot of consolidation going on in the market there. A lot of those big providers are buying over the smaller providers. And as a result, there's some concern that there would be, let's say, pricing power given to some of those larger providers, which could be very, very difficult for those trying to access this kind of information. And so they recommended to the EU as well to have a periodic review of these ratings as disclosures evolve to make sure that they're still fit for purpose.
Thanks very much, Deirdre. We may come back later on if we've time, just a few questions on that, but I might just move swiftly into the skills and training piece. Irish Funds published the ESG skills paper in May this year. I authored this paper with a lot of help from Patrick Rooney and an awful lot of contributions from industry members. So thanks very much to Irish Funds for the opportunity to do that. The key drivers behind that paper were really the Roadmap Action 2, which roadmap was launched last year, accelerate access to sustainable finance knowledge and skills. So really the funds industry was required to contribute feedback on skills and training needs. The second big thing obviously was the new EU Sustainable Finance Regulatory Framework imposes a huge amount of requirements, many of which you've just heard over the course of the last few speakers. So, an awful lot of SFDR, EU taxonomy, UCITS, AFMD, delegated acts. And then the Central Bank also published a letter on the 3rd of November last year, which really set out its expectations of all regulated firms regarding climate and other ESG upskilling. So upskilling in that area really has become critical. And then finally, there was an awful lot of research done in recent years by SkillNet on a cross-sectoral basis in Ireland and most recently in Canada. So that indicated the existence of significant skills gaps and the need for training within the financial services industry. While input was given from asset management and fund companies into that, we decided that a fund-specific survey and fund-specific research was required to ensure the fund's needs were addressed. So really our objective was to identify all the skill and training needs across the funds industry, easier said than done, and then make recommendations in relation to the provision of training courses. So we also wanted to find out the root causes. So I suppose our approach to this was slightly different. Many Irish fund administration companies and fund management companies, they're part of a multinational group, typically headquartered overseas. And consequently, group strategy around ESG and many other things is driven from outside Ireland. So that meant that the traditional top-down survey approach, where we interview senior management or a couple of key people in Ireland on their ESG skills gaps and their needs, in itself wasn't going to be effective. So we decided to take that's really useful for us with upskilling rollout and validating the needs, but really we needed a combination of a bottom-up approach. We needed interviews with subject matter experts, hiring managers who are looking for people in these roles, and then previous participants of structured training. So we conducted all that really to determine the appropriate needs and the rollout approach. So we try to do this as scientifically as possible as well. So we did look at the feedback from all the previous research conducted by SkillNet, and that indicated that the training wasn't role-specific or level-specific. So to address that, we built out a matrix detailing the various fund industry roles. I think we had 47 of them in total, and then the key attributes of those roles. Second, we interviewed various hiring managers within the specific firms. But we also got job specs. There's an awful lot of information up on the web and up online. Job specs for a lot of these roles, even traditional roles that have a ESG wrinkle in them now. So we were able to pull an awful lot of proper hard information on these to validate the skill needs for each role. Next up, we sought additional testimony from those who attended structured training and those who were subject matter experts in both the role and the appropriateness of the available training. And then we got an inventory of the sustainable finance courses. We reviewed those and we mapped these to the roles to identify the training gaps. And then we validated that again with the industry members. So there's an awful lot of over and back with these different parties. Interviews were also conducted with industry leaders and subject matter experts performing key roles. We did a lot of that in Q1. And then we also had interviews with senior management and middle management in a lot of the firms in the industry as well to get an understanding behind some of the root causes. And we also discussed some of the additional needs that they had directly and then actions to address this gap. The suggested training then was segregated between really general upskilling and then specialist requirements. So if you have somebody in compliance, they've got specialist needs. They're going to be in a different course to somebody that just has some baseline or some oversight function that may just need high-level needs. Same with reporting, compliance, were a couple of the specialisms that were called out. And then the other piece was really the availability of training courses initially seemed to be one of the things that was highlighted before we went into this. But it wasn't the only obstacle, that was identified to upskill in the industry. So I suppose, what did we come up with? What are the root causes here? And the first up was really industry awareness, and a bit like Jack said, it's not all bad news. There are a lot of specialist roles, and particularly the roles around investment management process, that are very, very well skilled in the industry and well trained. And they've got a very, very strong awareness. And this was called out, particularly in the Canadian paper as well. It was, that areas of asset management were much further ahead maybe of other sectors. But outside of that, roles outside of that area, really, the awareness we found of ESG and the training courses availability was pretty low. So effectively, staff and management didn't know what skills they'd need. And number two, they didn't know how to get them. So we had a lot of anecdotal, examples where staff were running to managers going, can I go in this course? And the management weren't able to determine really whether that was appropriate for the staff member to go on. We asked CEOs, what did you need? And they said, listen, tell us what courses are relevant for the staff roles in our organisation. So that's ultimately what we tried to lay out in this matrix. Next up was a sort of lack of company support, and some of that was probably down to the awareness of the courses, but a lot of it is employee driven. So a lot of staff are sourcing training materials themselves, upskilling themselves in a very unstructured fashion. That's great, but it's not really scalable. So a lot of the training happening we saw was employee-led rather than company-led. So, we're trying to make sure that's addressed as well. And some of that will be coming from that central bank expectation as well, that the board and senior management, will be promoting a culture that places emphasis on climate and broader ESG issues. One of the things that really came out that was pretty startling as well was the management and senior level uptake. So typical management and senior level in industry and in anywhere else in the investment funds industry really has the 15 plus years of experience. They're typically already have qualifications, be it CFA, ACCA, ACA, and this group is less likely to have the capacity or the inclination to commit to, say, 3-month courses or 6-month courses to upskill. A lot of the roles are very short-term focused as well, particularly for listed companies. So we need to make upskilling a lot more attractive for those individuals in that key target group so that they're actually getting upskilled. Courses need to be more concise and over a shorter duration, using a flexible modular approach. And then I suppose the last thing was really course availability. And I mentioned that courses aren't level or role specific. And there's a lot of good courses, but it's very, very difficult for participants to identify which course is a fit for them. So a company might send 5 people to the taxonomy course, 4 people think it's great, it's perfect pitch for them, and somebody else in a different role is saying it's way too detailed or way too not detailed enough. So, we had those challenges really. So in terms of findings, first one really was regulated roles need specific training. The training needs of board members and all personnel in regulated functions is a primary focus. So fund directors need to be able to understand, challenge, and question senior management and the investment manager and sustainability risks. They also need to be able to sign off on policies, and principal adverse impact statements, things like that. So there's an awful lot of upskilling there, and there's an awful lot of focus really in those regulated roles, the DP roles as well. I mentioned the modular approach. We did get that feedback that some were too detailed, some weren't detailed enough. So really we were looking to really split between those that need high-level knowledge, like oversight roles, and then the practitioners that need the specialist knowledge, the more subject matter. So we've broken out our needs into those 2 categories really, and then broken it into further modules beyond that. Timing was a big thing. So positive feedback was really received on a number of courses out there. There's some very, very positive feedback on the CFA certificate in investing, ESG investing. It's well subscribed for as well. So one of the main challenges noted was, I suppose, the duration. While that's a great course, middle management, senior management have challenges trying to get availability to go on that. So While we need to expand the availability of courses like that, and other very good courses, we also need to find a training solution that can be consumed easily by senior middle management. Format of training, so some of the taxonomy courses, other TCFD courses in the banking, there was great feedback there in terms of the workshop approach. That is noted as being very effective, particularly in areas that are emerging now. So the regulations have been changing, implementation is in flux. So, the workshops between industry peers, will be very effective on the more practical aspects of implementation, such as data. A lot of the roles, as I mentioned, a lot of the roles are based outside Ireland. There's things like sales, there's other areas that are particularly out there. ESG research may be outside Ireland. So specific training needs for areas like sales, like on greenwashing and other real risks, they need to be factored in as well. So facilitating sort of workshops on that side, and aside from just focusing the roles that are Ireland-based, there's probably the potential also to offer training to employees located overseas and making sure that they're, upskilled in the areas that are relevant to them. Finally, on location, we have 40% of the fund industry is based outside Dublin. I think we've got our Clare community there in the background there. So consideration, will be needed to, for hosting and delivering training effectively outside of Dublin as well. Just touch briefly on the non-EU requirements and the future proofing, which sort of tie together. A lot of the focus is on EU regulatory requirements and our sort of reaction to those. So Ireland has an international service centre. So really, we need to be looking beyond just the EU requirements. We're looking at UK, US, Deirdre touched on as well with what the SEC is doing with the other new requirements coming in, but also future-proofing. TCFD reporting is going on in Ireland for UK and for Asian funds as well. It does underpin the principles used by regulators and for frameworks globally. And while it's not mandatory here, it'll give us a good opportunity really to position Ireland as more a global centre if we can upskill in that area as well. So I suppose maybe just to mention briefly on the roles matrix. So we identified 47 roles across the funds industry. And you've got your regular corporate roles. So that's your COO, CFO, CEO, head of compliance, those ones that you pretty typically have in every organisation. Across through the different service lines, and you've got depot to fund accountant to audit to independent director. So we had all those mapped out. And then we segregated them obviously between C-suites, mid-junior levels, and the other specialist roles were called out, and then designated person roles. So then the big exercise was we split out 50 different individual skills underneath each of those roles. So they were sort of bifurcated into baseline technical knowledge. So your real basics, ESG 101, UN SDGs, and then your next piece would be really sustainable finance regulation. So there's 16 topics in there. And then some of the more problem-solving areas that may require some STEM skills and other implementation abilities that may not be necessarily present in companies. So there's 25 items included in there, understanding the impact of ESG factors in all asset classes. Other problem-solving abilities as well were called out there. So on the right-hand side then, we mapped all those to existing and proposed training. Sounds easy, but I suppose to map them effectively, we broke out the training into the different components of the training and then mapped them to the individual skills. So really what we came out with at the end was, here's the courses that you need to be a fund accountant, a auditor, whatever other role you may have in the industry. And then we also identified gaps there where courses need to be developed. So I'm just going to maybe move quickly on. The key recommendations really, we did note that there was a number of courses that needed to be developed for the funds industry. So we've one of those in implementation at the moment, so that's been developed, and that's a basic ESG 101 for funds. So, it's got your basic Paris Agreement, net zero, a lot of those components in it. We also looked at the training course that could be expanded. So they're almost perfect, but they might need an extra module for funds, or there's not enough capacity, because a lot of these are oversubscribed as well. And then we were looking at, one of the big items was more concise course description on the item 3 there. And targeted marketing will help companies and individuals to understand what they'll achieve by attending the courses. We had additional, like I mentioned, we have additional technical courses in there. And then, assess the demand for the other courses for distribution and maybe for other roles that are outside of Ireland. So really the key stages to upskilling Ireland we concluded on was, one, get the industry up to a good baseline level. And that's just through the steps we just spoke about. And then kick on with establishing Ireland more as a centre of excellence proactively with TCFD and other areas that aren't just EU regulation. So we can be a true centre. So I suppose, as you can see, Irish Funds has taken a leadership role in addressing these skills gaps in the funds industry. And there's likely themes here now that will resonate across the other sectors as well. So I might just take it back to the panel maybe for one final question just before we conclude. So I suppose, guys, we've gone through the evolution of data and the skills challenges. You know, what difficult choices are asset managers going to have to make on the back of these challenges? I might put that to you, Ciaran, because we haven't heard from you for a while now. So
yeah, I mean, skills and data is something that a lot of managers are dealing with right now, and identifying those parts of the business that need to be upskilled, like you spoke about there, Cathal. It's not always clear, you know. For example, does somebody working in operations, you know, how much do they need to know about these various ESG ratings, as opposed to, let's say, a fund selector, you know, who if they're selecting a fund and it's going into a fund which has an ESG objective, an Article 9 fund, let's say, I mean, they have to know what they're doing, right? They have to be able to identify the data, spot the right fund, do the correct due diligence. So I would think that maybe is a part that's going to be very challenging if for organisations, is to try figure out where the exact training needs to go.
I'll pass it over to you, Jack, just for final thought on it.
I would actually look at it from a different perspective. So all of what Ciaran talked about is really important. But then you've also got the asset manager or the service provider. Internally, what are the skills required to look at their own ESG policies internally? Their investors are probably asking them the questions around, you know, what is your policy? What are you doing around carbon? How are you reducing your own footprint, etc.? They're going to need internal people to do that reporting, to capture that data. And so, yes, there is all the skills that we need in terms of analysing for our investors, but actually internally as well, we need to have that component. So I think that's going to be really, really important for asset managers to think about as well.
That's great, Jack. Sorry, Deirdre, we didn't get across to you, but I think we're just up against the clock here. So just before we finish, I'd like to briefly acknowledge the work that Irish Funds has completed recently in the area. I think we have the policy and legal working group led by Tara Doyle, and the service and data working group Rights Chair. They've been very active. There's very motivated teams there. And there's a lot of subgroups as well, which have just been churning out thought leadership and responses to consultations. So we're very lucky to have such strong support from the Irish Fund Secretariat, and particularly Patrick Rooney, who's just working tirelessly and behind the scenes in a lot of this stuff. So just in terms of output, just to call out a couple of items from Irish Funds during 2022. We had the publication of the Irish Funds paper, Integrating EU Sustainable Finance Duties for Fund Management Companies, aka the MANCO paper, which was very, very well received. It's a huge amount of work went into it, and it's been held up as a very strong guide for approaches. We also had our SFDR Level 2 periodic reporting Q&A, leading on from our Level 1 reporting Q&A that we had earlier in the year. And we had a report, obviously the one that I spoke about earlier on ESG training needs and recommendations. Aside from that, we did a huge amount of webinars, particularly in the middle of the year. An awful lot more things are going online as well because we're able to accommodate more participants. And then there's a huge amount of engagement with the Central Bank of Ireland and Commissioner McGuinness directly, along with the EC Commission, the European Commission, on the Sustainable Finance Framework. So really, I'd just like to give a quick thanks to Sustainable Finance Ireland for the opportunity to present today, and congratulations on an excellent conference. I'd like to just thank the panel for all their contributions and excellent presentations, and thank you all for listening today.